So we dreamt up a particularly exciting topic to keep you awake after lunch. So it's not just US FET, there's a kind of more of a global aspect as well, but we're going to focus on an aspect of FET primarily, but then kind of move on to a few other bits and pieces as well. I mean, I think just as a general comment, I've been sort of providing a limited amount of US tax advice via my sort of tax partner, Asher Harris, for probably 4 or 5 years now. I've been working on a few projects for a number of clients. And it's interesting because what was kind of, what has dawned on us over the time of doing this is the US actually does operate a very different system to Europe. Not only are there more, states stroke countries to deal with, but they tend to deal with tax in a very different manner. Kind of as an example, if you're a domestic insurer in the US, writing business in a particular state, you sort of have a premium tax charge typically. That premium tax charge can almost be akin to a corporation tax charge rather than a transactional IPT in some cases, because you can get deductions and reliefs against your premium taxes. And then obviously if you're a surplus lines insurer, the surplus lines broker will typically pick up the tax, but as an insurer you may have some kind of regulatory filings to make. And then if you buy insurance from an unlicensed insurer, typically, maybe you're captive in Vermont or captive in Bermuda, you may have a self-procurement tax liability in a particular state. So there's a number, and it's almost the structure of the transaction almost determines what tax could apply. So it's a very different approach, whereas in Europe it tends to be, well, if there's a premium tax, regardless of the nature of the relationship. So it does tend to work a bit differently in the US, and I think it's sort of getting to grips with that and figuring out the structure of the transaction, who the parties are, will determine the tax treatment and the tax liability going forwards. So what I'm going to try and cover off in the next kind of 30 minutes or so is, as I say, US FET. Now this was a presentation I did, it was earlier in the year actually. We did a half-day session in Dublin, and it was regarding this Validus case there, and really it's kind of the same presentation, plus a little bit extra at the end to bring us up to date with sort of current events really. So there's that, and then touch on sort of global tax regimes and kind of compare and contrast how different countries tax insurance transactions or insurance activity in those particular countries. So in terms of US FET, as it says there, it's a tax imposed on insurance policies issued by foreign insurers. So if you're a non-US insurance company and you're charging premium to cover a US risk, you could potentially be exposed to an FET liability. The legislation says that the insured, the insurer, and the broker can all be held liable for the payment of FET. Now, typically what tends to happen is the local insured will settle the FET, but the legislation does provide that any one of you can be held liable for the payment of FET if it's not settled by any particular party. As it says, there's kind of, two main rates of tax. There's a sort of direct property and casualty at a 4% rate of tax, life, sickness and accident at 1%, and then reinsurance of 1% rate as well. I think for us outside the US, the sort of the big issue is this idea of a closing agreement. So if you're domiciled in a country that has a double tax treaty with the US, and the double tax treaty talks about FET, and you sort of meet certain criteria laid down, you can apply for a closing agreement. Once you've got that closing agreement, you can then gain an exemption from FET. Now, historically, you used to have to physically apply for a closing agreement, and in the IRS, the Inland Revenue Service would say yes or no, you're passed, and you'd have the closing agreement. What happened, I think maybe 3-4 years ago, it kind of moved to more of a self-assessment approach where you would decide whether you qualified or not. And many people have taken the view that, well, therefore, we don't need to apply for a closing agreement. Now, technically, you still need to apply for a closing agreement, but determining whether you apply or not is much more kind of self-assessed. I think the IRS have the right to kind of, ask you for a copy of the closing agreement if they want to. I don't think it's massively enforced because it's more self-assessed. But I think, you know, if you're a reinsurer, an insurer, or an insured, it's probably a good question to ask your insurance company or your reinsurer. Do you have the closing agreement in place? Is it signed? Because that's kind of the ultimate proof that you can apply for the exemption. The UK is one such country where an exemption is possible. Ireland is another one. And kind of most kind of Western economies will have some kind of double tax treaty. Typically the countries where you can't get this exemption would be the sort of the low tax economies, the tax havens, you know, the Caribbean, Bermuda, Cayman, those kind of countries. But it's interesting because as part of the closing agreement, they do look beyond you and where your insurance company is domiciled. They'll often look to see where the parent is, the share structure, you know, other operations which may fall out of the jurisdiction, maybe into, you know, if there's a Bermuda holding company, that may well impact your ability to get a closing agreement and get an exemption. So there are a number of things involved in that. My colleague Asher, he's experienced in preparing and submitting these closing agreements. So he's got the knowledge to be able to sort of pull a closing agreement together, get it passed through IRS, and get it done. So that's something that he's worked on for a number of clients in the past, and he's sort of able to offer that particular service going forwards. But as I said, you know, the UK is one such country where you can get this exemption. So just to talk you through sort of a quick working example. So as you see here, you've got a map of the US, and there's an insurance premium paid to a foreign insurer covering a risk or covering a US risk. Now, when you say US risk, the location of risk rules that we apply in Europe, you know, it doesn't apply word for word in the US. Broadly similar. They tend to talk about operations and business establishments, properties and risks and those kind of things. So it's broadly similar. They tend to use the term nexus rather than location of risk, which I think is I'm not sure whether that's a pure American phrase or it's an old English term that they've used, but they talk about the nexus being, you know, is the risk attached to that particular country? So what would happen? You, the buyer of the insurance, would pay the premium to the foreign insurance company. You paid a full amount of premium. You would then be required to settle FET with the IRS. Typically, that's how it's done. The local insured would do it. FET returns are submitted on a quarterly basis, and I think depending on the amount of FET you pay, you may even have to make interim payments kind of monthly or fortnightly, depending on the level of premium or FET you're paying over the course of a year. So there is a sort of there is a filing system in place, a filing structure in place. You file directly with the IRS to make the payment. And as it says there, if you do happen to have the closing agreement, then you're then exempted from the transaction. So no one needs to pay the FET on a particular transaction. Interestingly enough, we've had again through my colleague in the US, we've had sort of limited dealings with the IRS in the last few years. And they do tend to make HMRC look slick and organised by comparison. The IRS seem to be even more bureaucratic. You can never get the same person twice, and they're forever sort of chopping and changing, people in roles. So it can be very hard to get anything concluded with them. We had a particular client that wanted to settle liabilities going back. It was kind of about 10 years worth of liabilities. Now we were able to exclude the earlier years through statute of limitations, but just getting the current year settled, it took another 2 or 3 years to get to a stage where they'd sort of signed off on it. And there wasn't a particular problem. It was just very, very slow. It wasn't, they weren't challenging the treatment or the tax calculations. It was just a very slow, cumbersome process to get done. So kind of be warned, I think, if you are dealing with these guys, they can be a bit slow. So then what happens? So the insurer collects the premium. The insurer then decides to reinsure the risk to a non-US reinsurance company. Now that reinsurance premium could be subject to FET if the reinsurer does not have this closing agreement, does not have this exemption from FET. So that reinsurance transaction could be subject to the tax at 1%. But also that could then make the actual purchase of insurance taxable in the first place, because the reinsurer doesn't have the closing agreement. The direct placement then becomes subject FET as well. So you go from 0 to kind of 1 plus 4 to 5% rate of tax, simply because the closing agreement isn't in place. Now this is where we'll come back to this cascading, because this is where the world has changed very slightly. So evidently back in the 80s, the IRS introduced this idea of cascading. So theoretically, for every further retrocession, you could then have another FET liability based on that premium. And it was vaguely worded enough to talk about a retrocession of the US risk. So if any retrocession included an element of that US risk, theoretically the premium could be subject to FET. And these sort of cascading rules had sat on a statute for a number of years, but only probably 4 or 5 years ago did they suddenly wake up and think, well, let's try and generate some revenue from this cascading rules. So it sat on a statute, no one bothered about it, and then kind of maybe 5 or 6 years ago, the IRS woke up and thought, oh, okay, well, let's see if we can make some money out of this, and started pursuing a number of reinsurers to see whether there was any revenue in this for them. And this is kind of where this cascading kind of theory came from. So again, just to give you an example, here you've got the US risk, you've got the premium paid to a UK insurer, and then the premium ceded to a Bermuda reinsurer. Now, when I did this in Ireland, often the structure of an insurance company in Ireland, you'd set up your direct writing insurance in Ireland and the reinsurer in Bermuda. So the direct writer would write the European business and then reinsure back to Bermuda. So this probably applied more, I guess there's probably UK companies with the same structure, but it was certainly more relevant to Ireland. So you cede the premium back out to a Bermuda reinsurer, maybe even sort of a company within the same group. So the reinsurance premium is taxable because there's no double tax treaty between the US and Bermuda, which made the primary premium taxable as well. And then at the time, any further retrocessions would then fall subject to FET as well. So what happened, this company called Validus, who are a Bermudian-based reinsurer. Now, evidently what happened, the Bermuda market kind of decided they wanted to do something about this, so they're kind of looking for a stalking horse, effectively. And evidently Validus put their hand up and say, right, we'll do it. We'll see whether we can win this case. So the market kind of clubbed together. I think that the hat was sent round, and they all put a bit of money in each to support the legal fees. And so Validus took this case to court against the IRS, claiming that these cascading rules were unfair. As it turns out, the federal district court in the US found in favor of Validus. They used quite a complicated argument, or Validus presented quite a complicated argument. They talked about international law, and they referred to this due process clause of the US Constitution. Now, I'm not an expert in the US Constitution, but evidently these are quite complex legal arguments they used to try and defeat these cascading rules. As it turns out, the court took a much simpler route. They said, well, the statute, based on the way it's written, it applies to a reinsurance contract and not any further retrocessions. So they threw the case out. That's what they found in favour of Validus. They said the IRS is not allowed to impose FET on a cascading basis going forwards. So Validus won. Bermuda was delighted. The IRS had until the 6th of April 2014 to appeal the verdict. I think the case must have been around January of this year. And again, another quirk of US law. Apparently, if you're a taxpayer, you have 60 days to appeal. But if you're the IRS, you have 90 days to appeal. So they used most of their 90 days. They have appealed, but there's no further news at the moment. But the general view seems to be it's probably going to be a fruitless appeal. Because the view tends to be that, well, they're found once in their favour. There's not really anything further to argue about, I don't think. But I suspect the IRS are just appealing to slow it down. So that's kind of where we are at the moment, where the IRS have appealed against this verdict, and obviously until the appeal is heard, we've got no absolute clarification on what's going to happen. So what does that mean? To go back to this worked example, you cede your premium to the Bermuda reinsurer. Again, because the Bermuda insurer doesn't have a closing agreement or doesn't have an exemption, that's subject to FET. The direct premium becomes subject to FET, but no further retrocessions are captured in the FET legislation. So whatever you do after that point, there's no tax. There's no tax or no excise tax. So it kind of cuts the transaction off at that point. So what does it mean if you've paid any FET? So if you paid any FET under these cascading rules, and again in Bermuda there was a number of reinsurers who had, which is why they brought the case, potentially you can reclaim FET paid under these cascading rules. Obviously pending the appeal, start preparing your claims or reclaims to get the money back. So as it says here, statute limitations typically is 3 years for FET, but it's 2 years from the date of payment if you're claiming a refund of FET previously paid. So you've only really got a 2-year window to get this done in. So there's not a huge amount of reclaim available to you. But if you have paid the tax, then potentially you can reclaim it back at some point in the future. So that's the kind of the good news story, I guess. As I said, it may not impact us all directly here, but certainly if we've got sort of any reinsurers within our group that may be in Bermuda or other sort of offshore havens, then it may impact them. As it says there, our associate US Asher Harris, he can help with potential reclaims of FET, general FET advice, sort of ongoing compliance, and also obtaining a closing agreement if that's what you want. So he's the man to do that for you if that's the kind of thing you need. And obviously we'd be happy to put you in contact with you if required. So that's kind of the FET angle of it. I mean, does anyone have any sort of questions or thoughts or comments on that particular issue? I think that's a very good question, and to be honest, I'm not sure. Now, whether the delay is designed to do that, I mean, hopefully it shouldn't, you should be able to take your full 3 years worth of statute of limitations. But, I guess, depending on how the legal system works in the US, the longer they delay, the less years you can reclaim back, I suspect. So there may be a sort of a strategic move. Okay, we might not win the case, but we'll delay the amount of reclaims. So I think, sorry, yes. Oh, so you're lodging a protected, oh, okay, okay. Okay, well that may be your solution. Well, thank you for that. That's really helpful. So maybe that's the solution. As I say, I don't claim to be a US legal expert, but as I say, Asher can certainly help.
I have seen a US IRS treasury sort of submission, which is part, ready for their appeal.
Yeah.
So they clearly are going to.
Yes.
I think they still construct.
Yeah. I mean, I think as well, because the act, or because it was on statute for so many years and it lied dormant, and then they woke up and thought, oh, there's money in this for them. I think they established there was money in it for them, and then to get defeated so quickly,
Yeah, the cascading only affected the UK when the US-UK treaty was renegotiated in 2000, whatever it was. Before that, the Treaty Act said it couldn't be.
Oh, okay.
For the UK,
Yeah.
not for other
Yeah. I mean, and I think that brings up a very good point, is that, when you talk about double tax treaty, you need to look at each country's treaty on its own to see whether FET is reflected within the treaty, because obviously each treaty is kind of unique to the two countries.
Yeah,
so.
The UK one is one, again, different from all the others.
Yeah.
In that you wouldn't get the 4% plus 1%, you'd only get the 1%.
Yeah. So I think it's important to be able to look at each treaty in isolation and draw your own conclusions, rather than, assuming, if it works in the UK, it must work in Ireland. Unfortunately, that isn't really the case. So To be honest, I'm not sure when the appeal is going to be held, but it sounds like, as you say, Lee, that they're preparing their paperwork, so they're getting ready for battle, I guess. I'm not sure how quickly these things typically move in the States. Hopefully we'll get a conclusion fairly soon, because, again, it's one of those things where you just need some certainty. You know, almost one way or the other, you just need some certainty. I think with the uncertainty, it's very hard to, you know, to kind of manage your business and provide for tax and do all those kind of things you need to do to be prudent, really. So that's the US FET and the sort of the current status. Just to kind of move on, what I was just going to touch on for the last kind of 5 or 10 minutes is other jurisdictions, and just to kind of compare and contrast some of the things other jurisdictions do to tax insurance premiums. So if you go slightly north from the US, you've got Canada. Canada actually has a federal excise tax in place as well. It's a 10% rate of tax. And basically the tax is levied, as it says there, when you purchase insurance from an unlicensed insurer. Now, one thing you could do is if you went through a licensed Canadian broker, you can avoid the FET. But again, the Canadian authorities are very keen to work out, to establish that the broker is not just broker in name, the broker is actually doing his broking job. So if you just put the name on a piece of paper, you don't really get the exemption. The broker has to be doing the full broking job to gain that kind of exemption. Again, there's a number of exemptions there: personal accident, life, sickness, I think nuclear as well. But more importantly, at the bottom there it says, you know, if you can't buy the insurance in Canada, and if you can demonstrate that you can't buy the insurance in Canada, you then get an exemption from FET as well. I think they talk about 5 declinations or sort of similar. So, you know, you have to go to the market in Canada. You have to get a number of people to say no. And I don't think it's just based on price, it's based on actually availability and desire to write the business. You can then apply and get an exemption. So it is a bit sort of complicated, but again, you are able to be exempted from the 10% FET if possible. Moving on to Australia and New Zealand. Now, this isn't a sort of a federal excise tax, but it, you know, in a way it kind of works similar, which is why I wanted to touch on these two in this particular session. So in Australia, there's an income tax, which is, you know, it's this kind of 3% levy that's talked about. Now, it's often confused with a withholding tax, and withholding tax is slightly different. The way the income tax works in Australia is, if you're a local policyholder, you buy insurance from a non-resident insurance company, you have to pay income tax as the local insured, and it's deemed to be, a rate is deemed to be, you're deemed to make a 10% profit on the premium, tax at the local corporation rate, which is 30%, which is where you get the 3% from. So what you're supposed to do is the local policyholder, local insured, are supposed to withhold the 3% and pay it over to the Australian federal tax authorities. And they would sort of do that, I think, on an annual basis through their normal income tax filings. So it's not strictly an FET, but it works at a federal level in Australia, and it's just, again, applied to the situation where you're buying insurance from a non-admitted insurer. New Zealand effectively has the same rules, but instead of a local corporation tax rate of 30%, they've got a local corporation tax rate of 28%, which is why you get 2.8 rather than 3%. But in all other ways, it kind of works the same. Now, the interesting thing to note in all of these 3 countries as well is these aren't the only taxes that could be payable. You know, in Canada, you could have provincial premium taxes. There may even be a GST liability in certain provinces. In Australia, there's state insurance duties. I know there's some fire service levies and emergency levies in a couple of states as well. And in New Zealand, there's an earthquake levy. So, you know, again, it's going back to what we talked about this morning with the IPT and the VAT together. You know, they can often sort of cross over each other. Typically, in most cases, it's the local insured who's responsible, certainly when it's the insurance has been provided on a non-admitted basis. So as an insurer, you know, you need to make sure that your local insured knows what to do and knows how to treat it, and hopefully doesn't leave it with you to do, because you're not really in a position to settle these taxes in many cases. So that's the kind of 3 other countries, just as an example, kind of compare and contrast with the US. And then to look at 3 more, South Africa, Peru, and Singapore. Now these are all countries where sort of VAT stroke GST are applicable to insurance premiums. So in South Africa, as it says, insurance premiums are taxed at a standard rate of 14%. You can reclaim it subject to the normal rules, business recovery rates. If premiums are paid to a non-domestic insurer, there's a reverse charge mechanism in place. But also, claims can possibly be subject to VAT as well. I think that's more the case of the local insured, so it's kind of almost a taxable income, I guess, on the local insured, the receipt of the claim. So again, there's no premium tax per se, but there is a tax on the insurance premium, but it goes down the road of a VAT-style tax rather than a premium tax. Peru, again, is along the same lines, where VAT is payable at premiums at standard rate 19%. Again, there's a reverse charge in place if the insurer is non-resident. So we've come across this when we've been working with our captive clients. So typically, they write a global program. There's an insured in Peru, which is covered under the policy, and they say, well, what about the premium tax? And we say, well, there's no premium tax, but the local insured has an obligation to deal with VAT because there's a reverse charge issue. So whilst we wouldn't necessarily get involved in doing any tax settlement, our job is just to advise the captive owner, and the local insured what the tax situation is and make sure that they're accounting for it correctly at the local level. Again, Singapore's similar, although evidently in Singapore there's no reverse charge mechanism in local law. So if you're a non-admitted insurer, there's no requirement for you as an insured to reverse charge GST on the insurance premium. So hopefully that serves as an example of just how the world treats insurance premiums slightly differently. As I say, there's not always a premium tax. It can often be these kind of federal levies or GST, VAT levied on insurance premiums, which I think is why to kind of conclude, it's not just about premium taxes. In Europe we know that there are kind of 80 plus different taxes that could apply to insurance premiums. A lot of them are not strictly premium taxes. There's levies and charges and fire brigade charges. But when you move outside of Europe, okay, there may not be a premium tax at all, but there's some other tax that kind of sits in its place and is levied in its stead. So I think, I think you have to be mindful when you say, well, there's no premium taxes there. Well, okay, there's no premium taxes, but there may be another tax you need to consider. There may be a VAT charge, there may be GST, there may be something else. And I think it's always important to bear these things in mind when you're writing these kind of global programs. The other thing that often differs is again, when you're writing these kind of non-emitted, international programs, is the tax often becomes the responsibility of the local insured. To sort of jump down to the 4th point here, now we've had examples in the past where clients have rung us up and, insurance company clients have rung us up and said, so we've got these Canadian taxes on our books, can you help us settle them? So we sort of delve a bit deeper into the facts of the situation and kind of conclude, well, they're not your taxes to settle, they're not your liability. There's no mechanism in place for you to settle these particular taxes because under the law in Canada, the local insured is required to settle the taxes. So you should never have collected them in the first place. Now you've collected them, you've got a bit of a problem because you've got to get rid of them and give them to someone who can settle them. And often the person that's paid the taxes to you doesn't really want them back because then they have to do something. So I think from an insurer's perspective, I think it's important to recognise which taxes fall within your responsibility and which ones don't, and make sure you don't collect taxes where they're not your responsibility to settle them. It sounds like a really obvious, simple thing to say, but it does happen, and I've seen it happen a lot, and you're kind of stuck, with this pot of money on your balance sheet, and you don't really know how to do it, and so, if you can cut it off at source, at least you're stopping the problem rather than having to deal with the problem afterwards. So I think that's kind of an important message And again, what we tend to do with our captive clients, where they're writing these big kind of global programs across multiple countries, as part of the process is identifying, well, okay, in these particular territories, who is the responsible taxpayer? You know, who is the person who's going to be, is it the insurance company? Is it the local insured? You know, is it the broker? Who is the person who's going to be responsible and willing to pay the tax in those particular countries? And make sure they all do their jobs, because it's not always the same person. So I think it's kind of important to keep that at the forefront of your mind. As you say, otherwise you end up with these little pots of money on your balance sheet that you just can't really do anything with. And unfortunately, you're not really allowed to spend it on the Christmas party. So, you know, you have to kind of follow due diligence and attempt to settle the taxes where you can. And, you know, in some cases, I think you can engage with the tax authorities and explain the situation. But then I think it's a case of stopping it at source and making sure it doesn't happen again, really. So, I mean, the final point here really is just the payments of claims. Again, there may be tax implications. Obviously, Peter is much more of an expert when it comes to VAT and GST, but it's my understanding that in a lot of these countries that have, you know, VAT or GST regimes, including insurance premiums, often the claims can be subject to tax as well, and there's kind of, you know, reclaims available and offsets. So again, it's something else to bear in mind when you're kind of drawing up these kind of global programs, really. So as I say, you know, the conclusion really is, it's not just about IPT, it's not just about VAT, it's about a kind of a combination of the both, really. So it's being able to identify, you know, which taxes exist in which territories, getting the right advice, getting the right information, and figuring out how to settle them in each particular country according to the legislation. We've just started settling taxes in Australia for a particular client of ours. And so we gathered together all the information, and we read all the information, and we sort of dissected it all, and we figured out what we thought had to be done. Because it was the first one, and because it's, you know, I think the problem with Australia is the time difference more than anything else, because, you know, whenever the tax authority's working, you're asleep, and whenever you're asleep, you know, it's hard to get in touch with them. So because it's the first particular client, we took the view that we're going to use a local associate to file it just to make sure we're doing it properly and we've got someone on the ground. So we engaged with the local associate, again, someone we've used for a number of years, and you know, the good news was they were able to confirm that everything that we'd read and assumed was correct, which was good, and they were able to put the mechanism in place to settle the tax, working with the local insurer to fill in the right forms and get the taxes settled. So rather than working with the insurer, we actually sort of, because it's a captive, we work with their insured to get the right forms filled and submitted in a particular state or at a federal level. So that's where the way we work kind of differs slightly to standard, but it accommodates the tax in that particular territory. Having done the one, we're now kind of confident that we know what to do and we can do more of it going forward. So, but there is a, you know, kind of a learning for us and figuring out the process, and then applying the process going forwards, and that's kind of how we work. We still have the local associate on call if we need him for any particular issue. Again, previously we used the guy to help settle some historical liabilities, so he was very good at engaging with the tax authority and getting them settled. But going forwards, sort of in terms of ongoing compliance, with a bit of effort, I think we're happy that we can get to a stage where we can do these things, you know, kind of directly, straight from London, straight to the tax authority, with minimal extra people involved in the process. So that's kind of, that's me done. My sort of 45 minutes, there's about 5 minutes left. So does anyone have any sort of questions or comments, thoughts, challenges you'd like to make?
What about the GST and the potential reverse charges? You know, from Peru and
Yeah.
would it still be a reverse charge if the whole of the premium was paid to the UK? Or
I think it depends.
does it have to be the local?
It depends on who is involved in the actual payment of premium. So I think if the premium comes from the local insured, I suspect it's more likely to be reverse charge.
Yeah.
But if it's being paid by head office, there's probably not a reverse charge on the premium, but yeah, but I would suspect if there's then a subsequent management recharge, the management recharge would be applicable to that instead of the premium. So I think you're exactly right. It very much depends on who's actually paying the money. But if there is some kind of a recharge at the end of the year where they tally it all up and and square the books, I guess there's a chance it will be captured within the reverse charge mechanism somehow at some point of view. But no, I think you're right. It's one of those cases where you do need to know who's actually paying the premium. So. Okay, well, hope you found that helpful. As I say, with the FET stuff, as soon as we hear more, we'll let you all know through our usual kind of newsletters. But it's interesting, Lee, as you say, they're preparing themselves. So it sounds like they're not giving up the case just yet. So I guess there's a bit more fight in them left. Okay, well, thank you very much.